Have you ever wondered why order flow traders are able to time their exits and entries much better than retail traders or fundamental chart traders? Why is it the case that the market finds a support at a very specific level and gets rejected at a very specific resistance? These are all the questions that we are going to answer today. We are going to look at the market under the lens of order flow, and we will try to understand the structure of the market. Hi everyone, my name is Nuwan Ashad and I am a head trader at Blackline Trading. And in this video, we are going to break down the topic of order flow. To be very precise, we are going to answer three major questions. Question number one, what exactly order flow is and on what principles is it based on? Question number two, why prices move the way they move? What is the structure of the price movement? How imbalances are created and how imbalances are filled up? Question number three, how you can integrate order flow into your trading strategy and take your trading to the next level. So with that being said, let's have a deep dive and let's take this, break this topic down. Order flow trading is based on something called auction market theory. Auction market theory says that financial markets are no different than any other business in the world. The only major difference between the financial markets and any other business in the world is that financial markets are very, very fast moving. Auction market theory says that buyers and sellers, the only thing they do is that they try to find the fair value of a business. There are buyers who are willing to pay, who bid for a certain price, and then there are sellers who either accept their bid or reject their bid. And in this entire chemistry, the only major goal is to find a fair value of an asset. And this is how the market, the financial markets work. All the session, all the bigger time frames, small time frames, on a daily time frame, the only thing the buyers and sellers they try to do is that they try to find the fair value of an asset, of a stock, of market, of whatever asset you are trading. So let's try to understand this topic at a deeper level, and let's look at an example of a bakery. Let's say that you move to a new place and you open a bakery, right? And let's say the first day you start selling the piece of bread at $5 because you think that this is the fair value of the piece of bread, right? You see a lot of demand for that $5 a piece of bread, right? Let's say that the next day you bump that price up to $6, and what will be the first thing that you will notice? You will notice that the demand of the bread will decrease. Why? Because the price has gone much higher. Let's say that the next day you decrease the price from 5 to 4, and what will you see? You will see that there will be a lot of demand, right? So everyone will come and will try to buy that piece of bread. So in this entire scenario, there are three things that that have happened that we conclude. Thing number one is that $5 has been considered or is considered as the fair value of the piece of bread, right? $6 has been considered as too expensive by market participants, and $4 has been considered or is considered as too cheap for by market participants, right? This is exactly stocks prices, SPY prices, whatever financial asset that you are trading. This is exactly what happens every single day, that buyers and sellers, they meet and they try to find the fair value of the asset. Let's take this example and let's try to implement this concept on a stock, right? So let's say that Apple comes up with an iPhone, right? And the first thing that they do is that they set the price of the iPhone at $1,300, right? Let's say that hypothetically next day a news hits the market which says that there is some sort of issue with the iPhone's battery. What will happen? The stock price will go down heavily. Why? Because market participants will think that this new issue will create problem for the demand, right? And let's say that the stock starts trading from 150 to 140, right? Now, what has happened in this case? 150, which previously was considered as a fair value, given the new economics, given the new KPIs, given the new data, that price is considered too expensive. So the market starts discounting the future cash flows, starts discounting the potential future revenue, and the stock starts trading at a new price, which is considered which now fair value is 140, right? Let's say after a day or two, Another news hits, Apple comes up with a press release that we have fixed that issue. What will happen now? Stock will very quickly rebound and will trade back to 150. Why will it go to 150? It will go to 150 because that was the fair value which was considered previously by the buyers and the sellers before the news hit. So once the battery issue gets cleared up, stock will revert back to the fair value which the market considered as 150, right? So again, in this entire scenario, we can conclude that there are three major things that have happened, right? 150, high volume gets traded, considered as a fair value. Negative catalyst hits, stocks dumps to 140. Given the new economics, given the new change, that price becomes the new fair value. Things get better. That 140 considered too cheap now by the buyers, right? And stock reverts back to 150. This is exactly what happens in the markets on every single day. So in the world of order flow, this is called the move from balance to imbalance. Right? Stock was in balance at 150 right here. It went through an imbalance phase, starts getting balanced again at 140, reverts back to the balance once the news hits. Right? So overall, we have two major phases. We have balance and we have imbalance. Now, your job as a trader is to find those balance and imbalance pockets and try to capitalize on that. And the most of the money is made in the imbalance phase, right? Why? Because in the imbalance phase, the market goes into discovery mode and tries to find the next fair value. And nobody knows where the next fair value is until the floor is found. And in the order flow language, the floor is found at the next fair value, right? So in this example, 150, which was previously considered as a fair value, becomes a very, very pivotal point whenever the stock is about to go into an imbalance zone again, right? So 140 back to 150. Why 150? Because it was previously considered as a fair value by market participants, right? So again, your job as a trader is to capitalize on that imbalances move because that's where most of the money is made, right? So this is the entire concept of order flow. And in order to capitalize on those type of moves, you need to understand where exactly the volume is coming from, where exactly the big money is positioned, where most of the transactions have happened. And that is something you don't really see when you focus on these type of candles. What does this candle tell you? The only thing this candle tells you is that this is a bullish candle, right? But it does not tell you where, within this candle, where most of the volume has been accumulated. You literally have no piece of information that tells you where big buyers are positioned, where smart money has taken its position, and what is a reference point in terms of the volume, time, or price. Right? So this is a normal fundamental candle. Now let's compare this candle with the flow candle, right? And when you compare this candle, you try to break this down into flow candle, you see that the flow candle or flow chart gives you much more information compared to the fundamental chart. This is a flow chart. And what is it telling you? It's telling you, okay, this is a high, this is a close, this is a open, this is a low, but within the candle, these are the transactions that have taken place, right? This is a certain price, right? And at that certain price, let's say this is 150. At this certain price, these are the number of contracts that have been traded, right? Right side, here are all your buy orders. And on the left side, you have all of the sell orders. And at every single price points, these are the number of contracts, number of shares that have been traded within this specific candle. So this sort of structure gives you much more information when you try to analyze a certain structure, when you try to analyze a certain candle, bullishness, bearishness, or whatever the case may be. But this sort of information gives you much more insights, and then you can use such information to make better trading decisions. Let's first of all try to summarize what we have understood so far, what we have discussed so far. So we have discussed that order flow is majorly based on auction market theory, which says that there is literally no difference between any other business in the world and the financial markets. Market participants, buyers and sellers, the only thing they try to do in every single session is that they try to find the fair value of an asset, right? And once that fair value has been found, depending on the new catalyst, market goes from a balance to an imbalance. And your job as a trader is to find and capitalize on that imbalances move, because that is the area where most of the money is made. Now, having that part understood, let's try to take a step further and let's try to understand how imbalances are created and how order flow moves the price, right? So let's look at the imbalances. As we have previously discussed, this is how an order flow chart will look like. Right here in the middle, you have the price. On the right side, this is the ask, or basically these are all the sell orders. And on the left side, these are all the buy orders, right? Now, in the order flow language, there is one big difference, one big thing that you have to understand, and that is the interaction between the limit orders and the market orders. Limit orders and the market orders. And why it is important? It is important because limit orders and market orders, they tell you about the aggressiveness and the passiveness of the moves. So for example, on this slide, we have the price. All of these folks who are stacked up here, these are all the limit order guys, right? So all of these orders are limit orders, limit order sellers. On the left side, all of these guys, they are basically limit order buys, right? And why is it important? Limit order guys will literally wait for hours. They will place their order and they will wait for the price to come to that point and then they get filled. So that is the idea of a limit order. Versus a market order is basically all of the folks who are very, very aggressive about the price, right? So let's say that, so the interaction between these both of the guys will basically create an imbalance and will basically move the price from one point to another, right? So remember that order flow is basically an interaction between the limit orders and the market orders, because it tells you about the passiveness and aggressiveness of a move. So now let's take this example to the next level and let's discuss this slide, right? We said previously that here you have all the sell orders sitting right here, and here you have the buy order sitting right here. Now let's assume that an institution knows something, a new data is coming out, and they already have some information about how this data could potentially play out. And let's be very honest, we have seen such sort of moves happening multiple times, that right before the data comes, market starts dumping or market starts flying. So the question you always ask yourself is that why is it the case the move starts happening right before the data? Right? And let's be very honest, sometimes a lot of these folks, they have a lot of information that the usual retail traders, they don't really have such information. So let's go back to our example and let's say that an institutional trader, he gets an order from his boss that 1,000 lots have to be filled right now. Now, that guy is not going to place a limit order. Why? Because as we discussed before, a limit order, the concept of the limit order is that you basically put your order and then you wait for the price to come to that point to get filled. Now, that guy is not going to do that because that's going to take too much time, right? So what order he's going to go for? He's going to go for something called a market order. Market order means get me filled right now, no matter what the price is, right? So that guy is going to place aggressive market orders, and he will get filled, right? And how he will get filled, look at how the ask has changed. All these folks who were sitting here to get filled, all of those bids have been eaten up. All of those asks have been eaten up, right? So the big guy, he got filled, right? So if you look this chemistry, if you try to understand this chemistry at a deeper level, this move from here to here, because of the aggressiveness of the market order, this has created a big imbalance, right? And once again, that's what we discussed before as well. This is your job as a trader to spot those sort of moves before they happen and try to capitalize on those imbalances, because this pocket, these are the phases where most of the money is made, right? So how could we track that? We use something called a footprint chart, right? Because yeah, sure, this guy got filled and whatnot, but this guy is going to leave a footprint on an order flow chart. And this is how an order flow chart looks like, right? If you can have a deep dive into this, here you have the market is in balance. There are two major pockets that have been created. It is bouncing in between these two big levels, if you can see from the previous sessions as well. And what happens, initiatives, buyers come in and then they try to take the price higher. So how can we basically spot these imbalances? And this is what we see on the footprint chart, right? Because those orders, those market orders, those aggressive orders, those passive orders, they leave something which is called a footprint, right? Where at what price, how many contracts have been traded, and what was the chemistry of those orders, right? So this is how a footprint chart will look like. As said here, for example, you have poor highs made. What is a poor high? A poor high means that the price does visit a certain level but does not spend too much time there because of XYZ, because of responsive selling, or because of the speed of the move, or whatever the case may be, right? So here the initiative buyers try to take the price higher in a very rapid manner, like in a very strong manner. And here, whenever the price hit the lower bound, since it was a high volume area, buyers always kicked in and tried to take the price into the balance again, right? So this is a very classic example of a footprint chart. Again, this is the sort of information that you do not see when you look at a normal fundamental chart, because those charts, they really do not tell you what has happened within those candles, where most of the volume has been traded, where the aggressiveness came in, where most of the contracts were traded, right? Let's look at another chart. This is a second example of a footprint chart. And if we try to deep dive into those candles, what are you seeing here? Look at this beautiful candle. A lot of volume got traded on the upper side of the candle. A lot of trading activity happened here. Again, a lot of trading activity happened here, but not too much aggressiveness on the upper side, right? So this was rather a balanced area, right? Once there was no more aggressiveness, once there were no more buyers here, once there were no more aggressiveness, market orders here, price started moving here, price started moving lower, right? And look at how beautiful these balances are. They are showcasing you how hard sellers are coming in and are trying to take the price. So these are some of the very important topics in the order flow, because again, order flow does not mean that you are going to get a perfect entry, that it's going to give you a very precise signal where you should buy and where you should sell. No, it is going to provide you more insights. What areas are the important areas for OTF participants? What are OTF participants? They are other time frame participants, or basically smart money, which actually moves the market, right? Where they are going to tell you where most of the volume has traded, what prices are interesting for big money or smart money, and what are the areas which has a lot of trading activity happened, right? This is another example of an order flow chart. What are we seeing here? We are seeing the market imbalance. Market tries to break that balance on the downside. Here we have a failed auction. What is a failed auction? A failed auction is that the prices are considered too expensive. No aggressiveness here. No one is trying to buy here. Big money is not really interested. We have a failed auction. We trade lower. Market comes back again to that fair value price, tries to test it again. Is it still too expensive? Is it still too expensive? And the answer is yes. A retest of prior fair value and a fail again, a market trades lower, right? Let's look at another example. Here is a trend day. Market breaks out of a big balance area and starts trending higher. Bull zone defended once, neutral zone defended twice, and we are having a trend day configuration, right? Order flow gives you more insights regarding what exactly is happening within those candles, where most of the volume is trading, what prices are important to big guys, and if the market is trending or what is the precise resistance, what is the precise support, and what are the areas which are interesting for trading activity. So to sum this up, the last question, how you can integrate order flow into your trading system, right? Start understanding the structure of the market. Why does the market move in a certain way? Why does the price find a support at a certain precise level? And why does it get rejected at a certain level? You have to apply the principle of order flow structure from the bigger time frame. Start looking at charts from a bigger time frame and try to narrow it down to the daily time frames, intraday time frames, and start understanding. Do not simply just buy calls because the market is at support and short the market when is it at resistance. Always ask the question, why is the price getting rejected here and why is it trying to find a support here? There's always a story behind everything. So to conclude this video, to sum everything up, we have discussed 3 major points. Point number 1, what order flow is based on, and we learned that order flow is based on auction market theory. Point number 2, we try to understand how imbalances are created and why does the price gets rejected or find a support at a specific fair value or at a specific imbalance zone. And question number 3 that we discussed today is how you can integrate order flow trading into your trading system. So thank you very much for watching this video. If you guys like this video, go ahead and hit the subscribe button. In the next videos, we will try to cover some more topics on order flow, some more strategies on order flow, and how you guys can integrate order flow into your trading system. Once again, thank you very much, and I will see you guys in the next videos.